Welcome everyone to our webinar. Today's topic is solo 401k versus self-directed IRA, a guide for passive investors. My name is Natalie with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. Our speaker today is Brett Sininsky. Brett is a solo 401k consultant and self-directed IRA consultant here at Sense Financial, and he has a professional journey spanning over 18 years in real estate investing. He's also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. Um, Thank you, Brett, for joining us, and I will let you take the floor from here.
Okay. All right. Thank you so much, Natalie. Appreciate the intro and getting all this set up. Thank you, everybody, for joining in. No one wants to share where they're from, but that's okay. I'll get over that. We are hailing from Southern California, which is where our headquarters is, out of, if anyone's curious on that. And yes, this is the solo 401k versus self-directed IRA guide for passive investors. So in some ways, we're going to hit some wave tops. In other ways, we're going to get a little bit deep. But as always, in all of our webinars, we will give time for Q&A at the end. So don't wait to type it in. I won't address it throughout because I can't do both at the same time, but I will give 10 or 15 minutes or so at the end to address your questions. So without further ado, let me get started. Yep, you already heard about me. And just as an aside, we're not a fiduciary. If you need legal or tax or investment advice, please seek out the proper professional. This is educational only. Our mission is to help clients obtain control of and protect their retirement accounts. Proverbs 21:5 says, good planning and hard work lead to prosperity. Even the farmer has to say amen with a shovel in his hand, right? Why should you listen to us? I want to talk about that for just a second. Well, first of all, Dmitry Fomachenko, our founder, created this company, Sense Financial, in 2010. And prior to that, he was working for a real estate investment club and company and he was doing self-directed IRAs for that company. Shortly after that, he discovered the solo 401k after going out on his own and creating Sense Financial in 2010. And so we started doing the solo 401k in addition to the self-directed IRA. And to date, we have well over 3,000 clients that we've established over 4,000 individual retirement accounts of some sort for. And then we have 5-star reviews all over the place. So you can check us out on Google, or Trustpilot is another one, Yelp, of course, and other Better Business Bureau. We have a lot of 5-star reviews. So you could just see what our clients and what the public is talking about regarding their experience with us. So we're going to talk about really 2 different types of accounts today, but we're just going to briefly touch on the conventional side of things. So when you think of conventional investing, I like to relate it to the bus. In this case, this bus has to stay on the track, and it has to go where the track goes, and it has certain stops. You have to walk to the stop and be there at a certain time and get off at that stop and walk to your destination, or get dropped off or picked up. And so you're relegated to the pre-written path that the bus has to take. So that's the conventional side of investing, right? Think Schwab, T. Rowe Price, Fidelity, those typical traditional brokerages where you invest with them. You open an IRA or whatever type of brokerage account that you want, but you're relegated to what they offer. Primarily stocks, bonds, mutual funds, and ETFs that custodian offers. And then on the other side, which is where we come in with the self-directed retirement accounts, you have your off-road vehicle. And this vehicle can go where the bus can go, but it can also go off the road. And furthermore, it can go on the road where the bus can't even go. So it can you have a lot more flexibility to go over the sidewalks. I don't recommend that, of course, but you have the flexibility to go off-roading or go through a little bit of water, or go over. You have a higher clearance, right? So you can go over some rocks or some logs or whatever, and not bottom out the bottom of the vehicle because you're generally lifted a little higher, but you just have more flexibility. So we're going to focus on the right side here with the self-directed retirement accounts, which offer virtually unlimited investment options. So with the self-directed retirement account, you can invest in single family real estate, commercial real estate, syndications, apartments, whatever the syndication is offering, precious metals, cryptocurrency. You can do private lending. That's a favorite way of many of our clients to invest because of the passive nature of it. And we'll talk continuously about the passive nature of that, because that is the topic of today's webinar. And tax deeds, and the list goes on. And we'll talk about what the IRS says you cannot invest in, which is not a extensive list. First off, I want to give an IRA makeover example. Brad and Jennifer, their names were changed, living in Phoenix, Arizona, are real estate agents, and they're also a husband and wife, and they have the same business, the real estate business. They run it together, helping people buy and sell the place they call home, and of course helping investors buy and sell as well. And so when Brad first approached us, his goal was diversification. He had some prior jobs, W-2, he had some IRAs that he had built up over the years. But what he wanted to do was diversify, because at that moment in time, they were maybe diversified within the stock market, within different sectors of businesses, but it was all in the stock market, right? And he had little control over it. And so when he came to us, we helped him unlock his retirement accounts. We established a solo 401k for him because he qualified as self-employed as a real estate agent. And him and his wife both were part of that plan under the same sponsoring business, participating, contributing, rolling over their retirement funds. And as a result, Brad saw the benefit of maximizing the Roth contributions. And so because the solo 401k has a Roth component built into it, in addition to traditional pre-tax type of contributions and investing, he maximized the Roth. He could afford to pay some of those taxes along the way, and he started buying real estate. And he has quite literally millions of dollars worth of real estate in his Roth IRA and in his Roth solo 401k, excuse me. And so they're already over 59 and a half, so they can take distributions completely tax-free and penalty-free out of that. And so they're well set up for retirement, which they may never completely do because they want to stay qualified for the solo 401k. However, just a quick example of the power of what you can do with this. And so there's two options here at Sense Financial. We have the self-directed IRA, which, as you can see in the diagram, is for anybody. And then we also offer a solo 401k, which is primarily for the self-employed and their spouse. And we'll break down the differences between those two. So how does the checkbook IRA work? First of all, we call it a checkbook IRA, also known as an IRA LLC. There are companies that do I call it full custodial self-directed IRAs, where you actually have to go through the custodian for any and all transactions. Now, with a checkbook IRA, you are able to bypass the custodian for investments, check writing, paying bills, that sort of thing. But you cannot eliminate the custodian. The IRS says all IRAs have to have a custodian. So the LLC that we create is special purpose that gives you the power to bypass the custodian, but not eliminate the custodian, as with the case of the solo 401k. So here's how it works in a diagram. You come to us, we go through our process of asking you questions, you ask us questions. We offer free consultations anytime, by the way. So we get on the phone and we talk through your scenario and put ourselves in your shoes. So once you decide, okay, I want to move forward, the first step we're going to do after processing the order, we're going to open a new account with an IRS approved custodian. Now, this isn't the regular custodian that you're used to at Schwab or Vanguard. This is a self-directed custodian that allows for alternative asset investing. That's important. And then from there, you set up a qualified transfer. This can come from an existing IRA, 401k, 403b, really any qualified retirement account. Now, if you're employed and you have a 401k, sometimes if you're over 50 or 59 and a half, you can do what's called an in-service rollover, where you stay employed and they let you roll over the 401k. That's not in all situations. And if you're under, I think it's 50, but it could be 59 and a half. If you're under that age, then that money is really going to be stuck at that employer until it's a former employer. So you set up the transfer, then the LLC is created. This is a special purpose LLC, different than any other LLC that you currently own or conduct business in. This is for the sole purpose of being owned by an IRA. Now, you are the manager, that little man there with his hand up. You are the manager of this special purpose LLC owned by the IRA. And being the manager, you have check writing ability. You can sign on behalf of the LLC, and all assets are owned by the LLC, including all accounts that are open. So once the step 1, step 2, and step 3 are done, you open up the bank account, and then the transfer is done to the new custodian from the current custodian, and then the money's transferred into your new bank account that is owned by the LLC. This is a checking account, and you now can self-direct. So when you make investments, write checks, do wire transfers, however you want to do it, all the income and all the expenses go back into that checking account in the name of the LLC. All assets, all investments are in the name of the LLC. So the checking account is the home, if you will, for all the liquid funds until they are deployed into an investment. So what is a solo 401k? So that's a checkbook IRA in a nutshell. Okay. Now, what is a solo 401k? Well, as I mentioned in the prior diagram, it is for the self-employed and their spouse primarily. Now, you can have a partnership and you can still qualify for a solo 401k. What you cannot have is W-2 employees other than yourself and spouse. And so what that means is you can have 1099 independent contractors. You actually can have W-2 employees. You just can't have full-time W-2 employees. So that's under 500 hours per year is the threshold. They have to stay under 500 or be under 21 years of age. And so that's what qualifies you for a solo 401k in addition to that legitimate self-employment activity. What is self-employment? So if you're listening to this, you may not be self-employed, or you may not think you're self-employed. It's actually easier and more common than you might think, because any 1099 income, sole proprietor, Schedule C filing, that's going to qualify you for being legitimately self-employed in the eyes of the IRS to be able to qualify for a solo 401k. And I'm probably going to spend the majority of the time on the solo 401k because it is a superior product to the IRA, but you'll understand both when we're done here. So you can drive for Uber one day a month and be self-employed, DoorDash, whatever. Many of our clients are already real estate investors. And so because of that, they want to invest in what they know and realize that they can get a much higher return in real estate than they have been able to in the stock market. Furthermore, we'll talk about this in a few slides from now. You can actually use leverage to purchase real estate in your retirement account. When's the last time someone gave you a loan to buy more stock of a company or the S&P 500? It just doesn't happen, right? So there's some real tangible reasons why you'd want to invest in real estate using your retirement account. And so because they want to invest in real estate, they're already real estate investors, some of them. Some of them are already managing their own properties, but they're not really they don't have a property management company set up. So something that's real easy to do, even if you just have one property, you can quite quickly create a sole proprietor type company, start paying yourself 5-10%, whatever you want, of the management of the gross rent per month as a management fee. And now, voila, you're self-employed, but you really didn't change anything that you were already doing. Right now, you're going to have to file that Schedule C and figure that out. But you now qualify for the solo 401k, which, while you may not be able to take advantage of the high contribution limits because you're only bringing in, a couple $100 a month in management fees or whatever it is, what you can do is you can roll over any existing qualified retirement account, with the exception of a Roth IRA. That's the only one that has to stay an IRA. All other qualified retirement accounts can go into the solo 401k and be self-directed. And so that's the benefit of becoming self-employed. Plus, it offers you more flexibility in your life. You can work from home. You can get more tax benefits and write-offs. We have many real estate agents that are clients of ours that have a solo 401k, who, by the way, quick tangent on real estate agents. If you or anybody you know is a real estate agent, they really need to take a look at what we do at Sense Financial, and whether they end up going with us or not, they should consider putting the self-directed IRA, also the solo 401k, but definitely the self-directed IRA, since it doesn't have that self-employment requirement attached to it, in their tool belt, so to speak, so that they can add value to their clients. Because if they have a client who they could maybe own just their primary residence, but they have an interest in investing in real estate, well, why not say to them, hey, have you ever considered becoming a real estate investor? Oh yeah, I have, but I don't have enough money to do that. Well, maybe you do, maybe you don't. Do you have any IRAs or other retirement accounts that are, maybe you're not happy with the return of? Yeah, I've got an IRA of, $200,000 that I rolled over from a 401k from a former employer, and it's in Vanguard, and, it's doing okay. It's getting, 7 or 8%. Okay, great. No pressure at all. But did you know that you can unlock that and actually buy real estate with your IRA, owned by your IRA? And instead of just staying in the stock market, you can actually benefit at retirement time from all the income, all the appreciation, and everything that comes along with owning real estate. And they're going to be blown away because most people don't know about this. Well, let's say they go through with that. They unlock it, they look for a property, they buy it. You, as the real estate agent, can benefit from that, because now you're helping a client, you're providing more value, becoming that trusted advisor, and you're getting another commission check, and you're helping them get another home. So, quick tangent on realtors, because they're perfect candidates for self-directed IRA / solo 401k because of everything I just mentioned. All right, so how does the solo 401k work? Well, first off, you must have a plan sponsor. I already said it, you got to be legitimately self-employed. It doesn't matter how it's set up. It can be sole prop, corporation, LLC, partnership, whatever. It doesn't matter. Now, that plan sponsor can adopt a solo 401k plan, and we use a special purpose trust. So instead of the LLC, like you have with the self-directed IRA, we use a trust with the solo 401k. And so from there, you are the plan trustee. And as such, all assets, all accounts, again, just like the self-directed IRA, just replace the word LLC with the word trust. All assets, all accounts are in the name of the trust, which is owned by the solo 401k plan, that holds all the assets, and you are the plan trustee, which gives you that check writing power, signature power, all that stuff. And then from there, you can open up accounts, any brokerages, if you wanted to. Most of our clients don't, but some do. If you wanted to, you could, let's say you roll $200,000 into a solo 401k. You want to do some private lending, so you set aside $100,000 of that, and maybe you take another 60, because you want to leave some in the checking account, maybe not 40,000, but you want to leave some in there. So you take 60 and you say, okay, I still want to be invested in the stock market. Well, you can actually open up a brokerage account at Vanguard, Fidelity, wherever, in the name of the solo 401k trust. This is a non-taxable account. It's still in your solo 401k, and then you can invest in what Vanguard offers, stocks, bonds, mutual funds, while simultaneously using your solo 401k to invest in alternative assets like real estate and private lending and more. And so that's how the solo 401k works. And just like the self-directed IRA, all the money must go into and out of the bank. That is the home. The checking account is the home for the funds until you deploy them into whatever investments that you choose on behalf of the solo 401k. One thing to note for both of these, this is not your money. You are the fiduciary of someone else's money. Yes, you will benefit from it, but the IRA, the solo 401k are different entities than you. So you are acting on behalf of those retirement accounts. So your fiduciary duty is to grow them as quickly and as efficiently, and grow the value of as quickly and as efficiently as you possibly can. That is your responsibility, and also to make the best decisions, investment decisions, which go hand in hand with what I just mentioned. So how do the contributions work? Well, at the end, I have a diagram of a side-by-side of the different benefits of the IRA versus the 401k. So I'm going to save a little bit of that for that diagram, because it's all in one shot, and I think visually it's easy to see. But I do need to talk about the contribution limits for the solo 401k because they're so high. The IRA, if you're over 50, has an $8,000 contribution limit per year, and $7,000 if you're under 50. Well, the solo 401k has up to $76,500 if you're over 50, and up to $69,000 if you are under 50. And so it consists of two buckets. And so I'll break that down in a second. But before I do, Proverbs 21:20 says, "The wise man saves for the future, but the foolish man spends whatever he gets." So you have the employer, being self-employed, you wear two hats, right? You have the employer hat, you're the business owner, and then you're also working in the business. You're an employee of the business, okay? So in the eyes of the solo 401k, you can contribute in both ways, as the employer and as the employee. Now, as the employee, this is up to 23,000. This is called the elective deferral, or the employee contribution. And with the elective deferral, you can contribute up to 23,000 per year into the solo 401k. That can be Roth or traditional. And this is under 50. It has a $7,500 catch up if you're over 50, so 30,500 or 23,000 on the elective deferral. And on the left side there, the employer, you can also participate in what's called profit sharing. And what that is also known as the employer deferral, employer contribution. What that is a percentage of the net profit or the total payroll if you're S corp for the entire year. Now, both of these totaled up cannot exceed 76,500 or 69,000. And so, and don't misunderstand me, if you have a W-2 job, I want to hammer this home. If you have a W-2 job, you can't double dip on the elective deferral. So if you're 48 and you're maxing out that 23,000 at your W-2 job, you cannot put any elective deferral in to your solo 401k. But you can go from 0 to 69,000 as a percentage of your net profit, which is, if you're a single member LLC or sole proprietor, is going to be 20% of the net profit of the company can go in and go all the way from 0 up to 69,000. If you're an S corp and you're running payroll, then you could do 25% of the payroll, the gross payroll of your business. And so that's how you contribute on the employer side as the profit sharing. But you can combine the two. In the solo 401k, if you have a W-2 job that you're not maxing out the elective deferral on, let's say you're doing 10,000 out of the 23, you can still do another 13 in the solo 401k as the elective deferral. So you can contribute, that's per person. The elective deferral is per person per year, not per business or per W-2 job. So that's how that works. I just threw a lot of numbers. If there's questions on that, I'm happy to address them at the end. So hopefully that all makes sense. And by the way, both of those can be Roth contributions or pre-tax contributions. So the profit sharing, there's a little more work to make it a Roth contribution on the profit sharing side, but it's allowable and doable. And so I'm happy to answer any questions about that. But as far as the employee contribution, the elective deferral, that can just go straight in as a Roth or straight in as a pre-tax contribution. So I mentioned checkbook control briefly, but I do want to talk further about it. You have the full custodial accounts that require you, both with the 401k and the self-directed IRA. We do not offer those, but some companies do, where you go through the custodian for any and all transactions. So if you hold a rental property, this is where checkbook control really excels. As an example, I think it's better no matter what, but if you hold a rental property and you have payments, right? You have to pay the plumber every now and then, maybe replace the roof, hopefully not too often, but you have monthly income and you have typically some monthly outgo, possibly depending on how much maintenance or repairs, HOA fees, whatever it is you're paying, that have to go from the checking account. Remember, none of this can come from your personal money. This is a separate person, if you will, a separate entity from you. So all income and all expenses must be paid directly from the IRA or the 401k. And so with checkbook control, you can do online bill pay. So think about it's just a normal checking account. So we use a bank that we recommend, of course, They're third party to us, but we have a relationship with their back end management and they do it properly. So you don't want to go just walk into your Chase or Wells Fargo and have them set this up. They're not going to know how to do it. So highly recommend you go with the bank we tell you to. But that's another conversation. So once you establish that, you can write checks out of it. You can do online bill pay, wire transfers. By the way, up to 25 free wire transfers domestically per month. A free set of checks if you go with the bank we recommend. So there's some benefits to that besides just the relationship we have and them doing it right. But it just acts like a regular checking account. If you have the full custodial version of this, not only are you going to pay extra fees, transaction fees, but there's red tape involved. You have to go through the custodian for everything. And typically they have an online portal that you log into and you put a request in there. You upload an agreement that you want them to review and sign. And don't misunderstand this. Just because you have the custodian there looking at all that stuff or signing on it, they are not a second set of eyes on vetting a deal or making sure that you're not committing a prohibited transaction, which we'll talk more about. It's possible. If they get wind that it might be a prohibited transaction, I'm sure they'll say something. But by and large, they are just doing, as the custodian, what you tell them to do. Sign here, sign there, whatever. But because of that, there's transaction fees, depending on the package you choose. There's delays, 24 hours, 2 days, maybe. Sometimes it really depends on the custodian and what's going on. And so time is money. You couldn't just walk into an investment club and have somebody that you talk to that you know and trust say that they have an off-market property that they're pitching. Maybe they're doing a wholesale deal and it makes sense. Well, in that situation with checkbook control, you could just write them a check right there on the spot. Can't do that with a full custodial account, whether you have the IRA or solo 401k. So I'm done with checkbook control, but that's the benefit of it. We have a flat $250 annually per year. That's it. With the full custodial accounts, you're going to have different packages and different fee structures, and some are $100 a month, some are a certain dollar amount per year. They all vary, but by and large, the checkbook control is simpler, easier, and cheaper over the long run. All right, let's talk leverage real quick. The loan must be non-recourse. Okay, you cannot provide a personal guarantee. The property is the only security for the loan. It's typically going to require, it's really more like 40 to 50% down, not 30 to 50. And the property needs to cash flow, right? It's the only recourse if you default, if the IRA or 401k defaults, right? So the property has to cash flow a certain amount, not a lot, but a couple $100. And then you have to have some reserves. And in the IRA, I'm going to touch on this briefly, but in the IRA, if you do have a mortgage on real estate, whether it's in a syndication or just you owning, or your IRA owning a single family home or duplex or whatever, there will be unrelated debt finance income tax, which actually triggers UBIT tax, unrelated business income tax, in the IRA only. Okay, so I'm just going to briefly say this. If you put down 50%, that means 50% of the income, the rental income, or whatever it is you're getting per month or per year, is because of the mortgage, because of the leverage. So that 50% after you, and there's some nuance to this, because you can subtract the first 1,000 and you can depreciate and you can write off expenses and such from that 50% as it relates to the 50% of everything in the property. And then what's left over is subject to the UBIT tax. So it scales up to 37%, but it doesn't get there until around $12,000 of income after all those deductions that I just mentioned. So it's something you want to look into before you buy real estate with a loan using your IRA or invest in a syndication offering. But bear in mind, it takes a lot to get to the 12 because of all the deductions that I mentioned. And so it's not as bad as it sounds, but it's just something to be aware of. In the solo 401k, there's no UDFI or UBIT on leveraged real estate. Now, don't misunderstand me. You can still have UBIT in the solo 401k if the IRS says that you're running a business in the 401k or IRA, then your business income is going to be subject to UBIT. Same formula, same everything up to 37%. But that is the way the IRS levels the playing field between you running a dry cleaners in your retirement account versus mom and pop personally owning and running a dry cleaners, right? They have to incur all these taxes, but you're in this retirement account, so you're sheltered from it. They say, no, 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 you're still going to pay your fair share of taxes to level the playing field between the business owners and the retirement account. And that's where the UBIT on the running an active business comes in. We're here to talk about passive investing, so you probably shouldn't be considering running an active business in your 401k or IRA because that's not what it's designed to do anyway. Maybe it makes sense depending on the numbers, but just something to be aware of. And then we do have a list of lenders, non-recourse lenders at our website right there at that URL that you can go to, and they have different packages that they offer. Let's talk about disallowed investments. So there's a couple things. By the way, it's not a lot. The IRS doesn't tell you what you can invest in. That would be impossible to exhaust because it's virtually unlimited. But they tell you what you cannot invest in, and that's collectibles, and with the IRA, life insurance. So collectibles are disallowed for both IRA 401k, and life insurance is disallowed for the IRA. So when you think about collectibles, think baseball cards, stamps. Some precious metals are not allowed, by the way, so that could be under the category of collectibles as well. And then the other type of disallowed investment is disqualified parties. So I'm actually going to talk about that on the next slide. Excuse my terrible AI images that I created to create this PowerPoint, by the way. These are not real pictures. But this is an example of an immediate family. So the disqualified persons to your retirement account are you, your spouse, your children, their spouses, your parents, and grandparents. Okay, those are disqualified persons. What does that mean? I'm glad you asked. It means they can't personally benefit from an investment made by the IRA or 401k. They cannot do any work on behalf of an asset owned by the retirement account. Now, when I say work, I mean blue collar work. You can do white collar work. You can do behind the computer. Theoretically, you could even manage your own property, or IRA owned property. I probably wouldn't do that just because of, it's hard to walk that line of white collar versus blue collar. It's easier just to manage it, have a property management company, especially if it's out of the area you live in or out of state for sure. But that said, you cannot go swing a hammer, but you can hire the person that's going to swing the hammer. Okay. You cannot invest in a business that's generally speaking 50% or more owned by a disqualified party. You cannot go invest in that business. Some CPAs and attorneys who are a little more conservative will tell you they want that percentage ownership to be much less than 50, but I think technically it's possible if it's under 50. But look, just because you don't like wearing your seatbelt in your car doesn't mean you don't follow the rule and wear the seatbelt, and you still drive your car, right? You still get to point A to point B. There's still massive benefit to owning a car, and there's still a massive benefit to owning, having a solo 401k or IRA and doing alternative asset investing and following the rules. So it's not complicated to not commit a prohibited transaction. At Sense Financial, we offer unlimited client support. So if most of the questions actually come into play after the account is established and people are looking at certain investments and they ask questions, is this a prohibited transaction? Am I doing this with a disqualified person or whatever? A really good example is the real estate agent example. Okay. I have my license. I cannot go and I can go find a property. Again, white collar, blue collar. I can go find the property, but I can't represent my retirement account on that transaction. Even if I took no commission and just gave it as a closing cost credit to the retirement account, I still can't do that because I can't work for the IRA and I also can't get compensated for it. So there's a couple things going on there, but that's just to give you an idea of what you can and can't do on behalf of the retirement account. So here's that slide I mentioned with just a kind of side-by-side view of the benefits of the self-directed IRA versus the IRA LLC, aka checkbook IRA that we offer, and then of course the solo 401k. And a few things to point out. You can see the max contribution limit between the three are obviously massive. With the IRA, it's either a Roth or it's traditional. It's not both. You can do both, but they're two different plans. And so with the solo 401k, it has a Roth and a traditional all built in under one plan. Obviously, the solo 401k has that self-employment requirement attached to it. The other thing we didn't talk about is with the solo 401k, you can take advantage of what's called a participant loan. And we've had more than a couple clients establish the solo 401k and decide that they have to get rid of or want to get rid of this high interest credit card debt, consumer debt, right? Maybe it's 20%, 15%, whatever. So they take a loan instead of actually one gal, she was a nurse, she was a traveling nurse, but she actually established the 401k because she was going to take a early distribution from her IRA. And her CPA said, well, if you're going to pay off that $10,000 of credit card debt using your IRA, you better take out close to 20 because between taxes and penalties, you're going to have to pay like 10 almost at the end of the year when you file the following year. And then she found us and she said, oh, you mean I can only take out the 10, not the 20? And furthermore, there's no penalties. And furthermore, I am paying the loan back, but it's back to my own retirement account. So it's prime plus 1%, about 9.5 right now. And you can pay that back quarterly or monthly. It's up to you, amortized over 5 years or 15 if you use it to buy a primary residence. And bear in mind, this participant loan becomes your money once you take the loan. You still pay it back. So I guess kind of technically it's the bank's money or your 401k's money until you pay it off. But what I mean by it's your money is that you can use that money for whatever purpose you want, including an investment, what would otherwise be a prohibited transaction if that was being done with the retirement account, with the solo 401k. So the participant loan is huge. It's awesome. And many clients have taken advantage of that for those reasons I mentioned and more for sure. So I think that's all that I wanted to call out on here. And that slide hopefully has been up long enough for you to look at. We do have a free ebook that our founder, Dimitri, wrote, Proven Strategies to Transform Your Retirement Account into a Source of Passive Income. Now, it says IRA makeover, but it covers the solo 401k as well. And on that note, we only do those two products, okay? Dimitri has said no to a lot of add-ons over the years, a lot of shiny objects. We believe in the power of focus and the power of really of one thing, which is self-directed retirement accounts. But under that umbrella, we specialize in two things only. And that's the solo 401k and the self-directed IRA. And so we do both of those, and we do them at a very high level. Our clients are very happy with us. Most of our business comes from referrals. And so I think that's a testament to, people's happiness with our services. So if you ever want to jump on a call, I'm happy to conduct a complimentary consultation. My calendar's right there. You can grab a spot at that URL below, SenseFinancial.com/free-consultation. And we can talk through your situation. And now, after I take another drink of water, we will get into any questions that have been put in. So add in your questions. I am probably going to stop the screen share because that'll be easier for me as I'm going through these questions. So let's see, what do we have? And still, nobody said where they're hailing in from. Oh, I got one, Vail, Colorado. Awesome. Someday I want to get to Vail. I've actually been to Colorado, but only at a layover at the airport, so that doesn't really count. Let's see. Scott says, okay, well, let's see. Okay, we'll have to figure out the chat thing. So my apologies, guys. Maybe you only have access to the Q&A. Okay, so Ashok, sorry, it's kind of small. Ashok is asking, is it a good idea to convert traditional 401k investments into a Roth IRA in a solo 401k before investing into real estate to take advantage of tax-free distribution after retirement? Is it a good idea to convert traditional 401k investments into a Roth IRA in a solo 401k before investing in real estate? Well, I'm a little bit confused by the question. I'm sorry, with the before investing in real estate. I mean, it really doesn't matter before or after, because here's why. First of all, bear in mind a Roth IRA cannot go into a solo 401k. So if you have a traditional IRA that you wish to turn into Roth funds, you need to establish the solo 401k and do a direct rollover from that IRA into that 401k, and then convert those funds to Roth. Because again, once it's a Roth IRA, it can't go into the 401k. That may change down the road, but right now that's the rules. So, or that's the rule. So you want to do it regardless of whether you have real estate or not. You can also actually convert an asset, not just the liquid cash, into Roth as well. And that's kind of a hack actually to save on taxes. So you can get let's say you have $100,000 mortgage note with somebody who's, I don't know, maybe it's a short-term fix and flip loan for a year or whatever. So you loan them $100,000. You can actually go to a valuation company. We have one on our website under vendors, and you can actually convert that asset to Roth funds, to a Roth asset, if you will. And so this valuation company is going to tell you, okay, this $100,000 note is worth $80,000. I'm just giving an example. So now when you convert that, your total principal invested was 100,000. So not only is your 100,000 converted to Roth, plus all the interest and income from that note along the way is going to be tax-free down the road, but you actually saved 20,000 because you converted it at 80, paid taxes on 80, not 100, but the whole payoff, the principal payoff is 100. So that's actually kind of a cool little hack to converting asset from Roth to, or from traditional to Roth. Hope that answers the question. David says, if I'm a W-2 employee, but I'm considered self-employed through an LLC that actively owns or manages real estate, would I qualify for a solo 401k? You are a W-2 employee, but you're also self-employed through an LLC. Well, yeah, that would qualify you. Yeah, absolutely. Now, because you're managing, right? Passive income does not qualify you for a solo 401k. It has to be legitimate, earned business activity. So if it's just rental income, passive rental income, that's not going to qualify you. Even an Airbnb type short-term rental usually does not qualify you because you're filing that income on a Schedule E so that you don't have to pay self-employment tax on it. There is a way to turn that income from short-term rentals into actively earned business income, Schedule C, or however you want to do it. You can talk to your CPA, but it doesn't always make sense to do that. But if you're managing the property and you're receiving a compensation for doing that management, then yes, that would qualify you for a solo 401k. Good question, David. I have another question from Ashok. Can an individual have both employer provided 401k and a self-employed part-time solo Yes. Yep. And I think I answered that question earlier, or maybe after you asked it, because it looks like you put that in at 11:17. So that is, I think we covered that. The answer is yes. Is there a dollar amount that must be transferred into the newly created trust to start? Nope, no limits on that. You could do $500 here and $1,000 there, and you're probably not going to do it that way, but you could. And furthermore, you don't actually have to contribute to the 401k either from the business income. You could just use your legitimate self-employment activity to establish the 401k and then transfer in the existing retirement accounts and self-direct them into alternative assets. But there's actually no requirement to contribute. It's designed to contribute to, but no one's going to come bust you if you don't. Does a holding company as a single employee owner business qualify for a solo 401k? Possibly. Yeah. So one thing to bear in mind, and I didn't clarify this, Jay, good question. One thing to bear in mind with the employee thing is that you cannot have any W-2 employees, period. And in states where it's community property state like California, there's some nuance to this. It's actually getting into what's called control groups, and it's a very complex part of the tax law and qualifying for a 401k. So it's a little bit out of my purview since I'm not a tax attorney or CPA, but you cannot have any employees in any business, okay, at all, whether it's the business that's going to sponsor the 401k or not. It doesn't matter. You as a person cannot have any W-2 employees, again, working more than 500 hours a year or over 21 years or older. And the same thing with your wife. So in the community property states, even if you're not part of the wife's business or the husband's business, if your spouse has employees in their self-employed business, then you can't do a solo 401k in your business. Although in states like Illinois, we just did one where it's not community property. The husband had some employees, the wife didn't. We established a solo 401k for her self-employment. So that's kind of the nuance there. But to answer your question further, Jay, we'd probably have to jump on a call and kind of understand the situation a little more. Jay's from Fort Mill, South Carolina. Very cool. Is there a minimum amount of cash, Raya's asking, that I should leave in my solo 401k to avoid raising an IRS red flag? Minimum amount of cash? No. I mean, I would leave, a couple $1,000s or so in the checking account, especially if you're going to own rental real estate. You need some kind of money in there to make some payments every now and then and that sort of thing. But no, there's no minimum required. No. Okay, David says, I am managing multifamily units owned by my LLC, but I also work W-2. Yeah, so we talked about that. Please give me the company that can convert from traditional IRA to Roth. Well, if you want to do that, first of all, Sue, thank you for the question. There's actually not necessarily a company involved in doing that. You can actually do that conversion yourself. One thing I'm going to recommend, though, whether you have a self-directed retirement account or not, you can still do this. You go through the custodian. If you're going to do it at like a Vanguard or Fidelity, you're going to go through the custodian. Again, if you qualify for a solo 401k, let's talk about establishing that first, since the Roth IRA cannot go into the solo 401k. And then that way those Roth funds are in the solo 401k and you can take advantage of all the investments in there and what it offers. But I digress. You're going to go through the custodian on that. If it's a conversion, if it's a self-directed IRA or a traditional IRA at Vanguard or Fidelity, you're going through the custodian for that. Okay. That's the company, is the custodian. Even with the self-directed, there's still a custodian. And with the solo 401k, you're actually going to do this on your own. We have a client portal that has a ton of articles and downloadable tools that you can use for doing things like this. So you're going to fill out a document. It's 2 pages. And it's a document that explains that you're doing a Roth conversion and what type of funds these are. Are they rollover funds? Are they contribution funds? That sort of thing. And then you do it internally as the fiduciary of that solo 401k. Now, one more thing to note, double check with your CPA on what the tax liability is going to be before you do that. Okay. That's something that we, can't advise on. So that would be the quote unquote company that I would get involved is my CPA on that. So, all right. Well, with that said, there are no other questions. I appreciate all the engagement and all the attention. And if anybody wants to jump on, like I said, anybody wants to jump on jump on a call with me, you can visit that URL I mentioned, and you can just go to our website, SenseFinancial.com, and book a call there. It looks like Catherine added one more question, so let me get to that real quick. Can I set up a solo 401k using the income from the short-term rentals I own? Yes, you can. But the income has to be legitimate self-employment income, not passive, right? So as I mentioned a few minutes ago, if you're reporting the short-term rental income as Schedule E income, that is not actively earned income. That is passive rental income. So that's not going to qualify you. You could talk to your CPA about converting that to, business income instead. I'm not sure that makes sense because you're going to pay some more taxes on that, but maybe it does. If you can divert that money into the solo 401k as a pre-tax contribution, then you're going to defer the taxes on that. You're not paying taxes today, so that might make sense. Again, definitely a CPA question, but good question. Oh, there's a few more that just popped in. My bad. Let me keep going. Yeah. So Anne is asking, I'd like to digest. Yeah. Everybody who registered for this will get the recording a few hours from now. And then no IRA rollover is required to start a solo 401k. That's correct, Jay. If you don't have any current retirement funds and you want to start a solo 401k, you can fund the entire thing from contributions. You don't have to do any rollovers. That is absolutely correct. Same thing with the self-directed IRA. The IRA downside is that the contribution limits annually are so low, 7,000 or 8,000, that it's hard to build up enough without many years going by to do something as far as alternative asset investing. That's the downside of doing that with the IRA, but you theoretically could. And then, yes, definitely with the solo 401k. Good question. All right, going once, going twice. Thank you all so much. Really appreciate it. And with that, we are going to conclude today's webinar. Thank you so much. And you guys have a great day. Take care.